Picture this. You're making more money than you did 5 years ago. Your credit score is decent. You pay your bills on time. You're not stupid with your money. And yet somehow, you have less than you did before. Not because you're lazy, not because you're financially illiterate, but because you've been playing a game where the rules were written by someone else, the deck was stacked before you sat down, and the house always wins. Here's the uncomfortable part. They don't need to trick you anymore. The system works because smart people, people who read articles about compound interest and understand APR, make the same 5 mistakes over and over again. Not out of ignorance, out of design. This is the debt trap playbook, and if you've ever wondered why it feels like you're running faster just to stay in place, you're about to find out why. Let's start with a number, 77%. That's the percentage of American households carrying some form of debt right now. Credit cards, student loans, car payments, medical bills. The average person owes over $100,000 when you add it all up. But here's what's changed. 20 years ago, debt was mostly tied to big purchases. A house, a car, college, things you could justify. Today, the average American is in debt for groceries, for gas, for a phone bill they couldn't cover last month. And it's not because wages crashed. Median income has actually gone up. The problem is that the cost of staying alive has gone up faster, and the gap gets filled with credit. You're not falling behind because you're bad with money. You're falling behind because the math doesn't work anymore, and someone is making a lot of money off that fact. Mistake number 1, treating minimum payments like progress. Here's the first trap, and it's so obvious that most people don't even see it. You have a credit card with a $5,000 balance. The minimum payment is $150 a month. You pay it, every month, on time. You feel responsible, except you're not making progress. You're treading water. Let's do the actual math. At 22% APR, which is about average for credit cards right now, you're paying roughly $90 in interest every month. That means only $60 of your $150 payment is actually reducing what you owe. If you keep paying the minimum, it'll take you 52 months to pay off that $5,000. You'll pay $7,800 total. That's a 56% markup on money you already spent. But here's the designed part. The minimum payment is calculated to keep you in debt as long as possible without default. It's not optimized for you. It's optimized for the lender. It's like a game where the experience bar fills up just enough to make you feel like you're leveling up. But the next level requires exponentially more effort. The system isn't broken. It's working exactly as intended. And the worst part? Paying the minimum on time actually improves your credit score. You're being rewarded for staying in debt longer. Mistake number 2, consolidating without changing behavior. So you realize the minimum payment trap. You're smarter than that. You see an ad for a debt consolidation loan, lower interest rate, one simple payment, clean slate. Sounds like a power-up, right? Here's what actually happens. You take out a $15,000 personal loan at 12% APR to pay off 3 credit cards that were charging you 24%. You do the math. You're saving money. And you are. For about 6 months. Then the credit cards are paid off. They're sitting there with a 0 balance. And your brain does something interesting. It sees available credit as available money. Within a year, 70% of people who consolidate debt have racked up new balances on those same cards. Now they have the consolidation loan and the credit card debt. They didn't solve the problem. They doubled it. The loan wasn't the issue. The spending pattern was. And the system knows this. Debt consolidation is a $10 billion industry. They're not selling you a solution. They're selling you the feeling of progress while keeping you in the same loop. It's like restarting a level without learning why you died the first time. Mistake number 3, financing depreciating assets. Let's talk about cars. The average new car payment in the US is now $739 a month. For 72 months. That's 6 years. Here's the problem. The moment you drive that car off the lot, it loses about 20% of its value. After 3 years, it's worth half what you paid. After 6 years, when you finally own it outright, it's worth maybe 30%. You just spent $53,000 to own something worth $15,000. But people do it because monthly payments make big numbers feel small. $53,000 sounds insane. $739 a month sounds manageable. And here's the trap. After 6 years, that car is old. It needs repairs. You're tired of it. So what do? You trade it in and start a new 6-year loan. You never actually own the car. You're just renting it from the bank, one monthly payment at a time. And because the car is always depreciating faster than you're paying it off, you're underwater for most of the loan. This is called being upside down on a loan, which is a polite way of saying you owe more than the thing is worth. And the industry loves it, because an upside down borrower is a repeat customer. You can't sell the car to get out of the loan. Your only move is to roll the negative equity into the next loan and start over. It's a treadmill that speeds up the longer you stay on it. Let's pause here and zoom out, because these aren't three separate mistakes. They're three parts of the same system. The credit card keeps you paying interest forever. The consolidation loan resets the board without fixing the behavior. The car payment locks you into a cycle where you're always financing your next escape. Here's the part nobody tells you. The average American spends 34.5% of their income on debt payments. Not rent, not food, debt. That's a third of every dollar you earn going to pay for things you already bought. And because your income is spoken for before you even get it, you have no buffer, no savings, no cushion. Which means the next emergency, medical bill, car repair, broken appliance, goes right back on the credit card. The trap doesn't need to be aggressive. It just needs to be constant. Mistake number 4. Mistaking credit for wealth. Here's where it gets psychological. You get approved for a $20,000 credit limit. Your brain interprets that as access, as abundance, as proof that you're doing well. But credit isn't wealth. It's rented purchasing power. And the system deliberately blurs that line. Buy now, pay later. 0% financing for 18 months. Earn rewards points on every purchase. It all sounds like winning. But here's the trick. They're not giving you free money. They're giving you access to their money, with terms that benefit them. And the average person uses 30% of their available credit at any given time. Not because they need to, because it's there. This is the illusion of liquidity. You feel rich because you can buy things, but you're not building wealth. You're building a balance. There's a concept in games called pay to win. You can progress without spending money, but it's slow. Spending speeds things up, makes you feel powerful. Credit works the same way. You can live without it, but it's slower, more friction. So you swipe the card and the friction disappears until the bill comes. Mistake number 5, ignoring the real APR. Here's the last one, and it's the most insidious. You see a 0% APR offer, 12 months, no interest. You buy a $2,000 laptop. You plan to pay it off before the promotional period ends. Except life happens. You miss a month, or you pay it off in month 13 instead of month 12. And suddenly, you owe interest. Not just on the remaining balance, on the entire original $2,000, retroactively, at 29.99%. That's $600 in interest on a purchase you thought was interest-free. This is called deferred interest, and it's buried in the fine print of most promotional offers. It's not illegal, it's just designed to catch you. And it works. About 40% of people who take these offers end up paying the deferred interest. But even if you pay it off on time, here's what happened. You just gave a company $2,000 of your future income to borrow something today. You locked in spending before you earned the money. And while you were focused on that laptop, you didn't save anything. You didn't invest anything. You just moved money from your future self to your present self. That's not financial strategy. That's time theft. So here's the narrative you've been sold. Credit builds wealth. Financing makes big purchases accessible. Debt is a tool, and technically, that's true for some people. But here's the reality. Debt is a tool the same way a chainsaw is a tool. In the right hands, it builds things. In the wrong hands, it destroys them. And the financial system doesn't care which hand you are. They make money either way. The average credit card company makes 75% of its revenue from interest and fees, not from people who pay off their balance every month, from people who don't. The game isn't designed for you to win, it's designed for you to play as long as possible. So what's the way out? Not advice, not motivation, just mechanics. First, stop feeding the system. That means no new debt. Not for 6 months, not for anything. If you can't pay cash, you can't afford it. Full stop. Second, attack the highest interest rate first, not the smallest balance, not the one that feels most urgent, the one that's costing you the most money. Third, automate more than the minimum. If you're paying $150, set it to $200. The extra $50 doesn't feel like much, but it cuts years off the payoff timeline. Fourth, kill the credit limit illusion. Call your credit card company and lower your limit. I know that sounds insane, but available credit is a psychological trap. Cut off your own access. Fifth, treat financing like a contract with your future self. Every dollar you borrow today is a dollar your future self has to earn, with interest. Ask yourself, is this worth trading future freedom for present convenience? These aren't hacks, they're just the inverted playbook. The same mechanics that keep you in the trap can pull you out if you reverse them. Here's the thing nobody wants to say out loud. The economy needs you to stay in debt. Consumer spending makes up 70% of GDP. If everyone stopped borrowing and started saving, the system would collapse, which means there's an entire industry built around keeping you comfortable with debt, normalizing it, gamifying it, making it feel like progress. And it works because the trap is invisible until you're already in it. You don't wake up one day $50,000 in debt. You get there $47 at a time. A dinner, a tank of gas, a thing you needed right now and forgot about 3 weeks later. The system doesn't break you, it erodes you. So here's the question you should be asking. If you're making more money than you did 5 years ago and you're still broke, who's winning? It's not the economy, it's not inflation, it's not bad luck. It's a system that profits from your debt, rewards your compliance, and punishes your escape. The debt trap playbook isn't a secret. It's just so normalized that it doesn't feel like a trap anymore. It feels like life. And maybe that's the point. If you made it this far, you're probably not looking for feel-good advice. This channel breaks down the systems most people take for granted. Money, markets, the mechanics behind why things cost what they cost and who benefits when you don't ask questions. No hype, no gurus, just the economics they don't teach you, explained like you're actually paying attention. If that's the kind of content you want more of, subscribe to 8-Bit Economics. New videos every week that pull back the curtain on how money actually works. And leave a comment. Tell me which mistake hit closest to home, or if there's a system you want decoded next. The more you understand how the game is played, the better your odds of winning it. See you in the next one.